As we approach the midpoint of 2024, inflation continues to bedevil the American economy like an unwanted house guest who simply won't take the hint to leave. Despite the Federal Reserve's aggressive interest rate hikes over the past year, price pressures have proven more tenacious than many had anticipated. The latest data points are discouraging. Wholesale inflation picked up again in April, with the Producer Price Index rising 0.5% for the month. That brought the annual rate up to 2.2%, the highest in over a year, and the more significant Consumer Price Index report, due out Wednesday, is expected to show prices rising at a still elevated 3.6% clip over the past 12 months. These numbers throw a wet blanket on the optimistic forecasts from just a few months ago that inflation was finally turning a corner and the Fed could soon pivot to cutting rates. Instead, in remarks this week in Amsterdam, Fed Chair Jerome Powell was compelled to change his tune, noting the lack of progress on taming inflation so far in 2024 and saying his confidence in a continued decline is not as high as it was. This stubbornness is particularly perplexing given the Fed's historic campaign of rate increases, which have taken the benchmark federal funds rate from near zero to over 5% in just over a year. By Powell's own assessment, monetary policy, by many measures, is now restrictive enough to choke off demand and cool the overheated economy. Yet while growth has indeed slowed, the inflation virus seems to be mutating and finding new ways to spread. A major contributing factor has been the persistent strength of the labor market, which has kept wages rising at an unhealthy pace. Powell cited the April jobs report, which showed an eye-popping 550,000 new positions created, as evidence of an economy still running too hot. Where will this leave Fed policy? Powell reiterated his stance that further interest rate increases are unlikely barring a dramatic re-acceleration in prices. But neither is the central bank poised to cut rates and ease financial conditions anytime soon. Markets had been pricing in multiple rate cuts before year-end, but this now seems premature at best. Instead, Powell signaled that the Fed plans to keep its foot firmly on the monetary brakes, letting that restrictive policy do its work in a strategy of resolute, if grudging, patience. Krishna Guha of Evercore ISI predicted the Fed's next realistic window for easing could come no sooner than September. Contrast this with the situation in Europe, where inflation has continued to moderate and central banks are now able to contemplate rate cuts well ahead of their American counterparts. The Swiss National Bank and Sweden's Riksbank have already lowered rates, and the European Central Bank is expected to follow suit next month. In Amsterdam, Dutch central banker Klaas Knot, who sits on the ECB's governing council, touted this coming pivot and warned about declaring premature victory over Eurozone inflation. But he also dismissed suggestions that the ECB would be overly constrained by the need to follow the Fed's lead, saying any lag would have minimal impact on European price pressures. While this transatlantic gap may seem a minor curiosity, it speaks to the stunning role reversal now underway. For decades, Fed policy was the bellwether for central banks worldwide. Now Europe and other regions are able to exit pandemic-era easy money before an increasingly isolated and inflation-obsessed Federal Reserve. Of course, Powell and his colleagues still have the difficult task of navigating the U.S. economy to a soft landing, cooling inflation without causing a severe recession. The latest numbers complicate that challenge, suggesting a more protracted battle lies ahead to definitively break the back of this inflationary cycle. For American consumers and businesses, already fatigued by the highest prices in a generation, that likely means continued austerity, with interest rates higher for longer and price relief more elusive than many had hoped. It's shaping up as a summer of rising costs and lowered expectations, overhanging the economy like the humid haze of a Washington swelter. The Fed erred in initially misjudging and then underestimating this inflationary outbreak. Powell has rightly pledged humility and perseverance in response. Taming runaway price growth will require strategic patience and perhaps some economic pain to re-anchor American expectations. Bringing down inflation may demand sacrifice. But after a half-century of relative price stability, protecting that hard-won legacy should rank as an economic imperative. Ridding the economy of this stubbornly debilitating condition is a necessary if arduous step towards renewing America's promise of broad-based prosperity,